Thanks to everyone for coming. Really, thank you for taking your time today and coming to join us with our great panel discussion on what does a real impact investment look like. First of all, I want really to thank all the panelists today for taking the time and coming, and to all the attendees. I really wanted to do this session on impact because impact is we talk so much about impact, but actually I'm still asking myself what impact is, because there is so much talk, but I can see that much translated in action. And this is why I decided to do this event. I invited my great panelists, and I'm very happy to be here with you today. So before starting, let me introduce the panelists, which are 5 great experts in impact. Let me start with Deborah. Deborah, please introduce yourself.
Hi, good evening, everyone. Thank you very much, Max, for having me. So my introduction to impact came, it's been an evolution. I'm based in Dubai. I used to be a partner with one of the world's leading executive search firms, and I came across a company that was having bad practices, but they had a CSR initiative, and I thought that was ridiculous, and I went on this quest, and I ended up developing this protocol called Amani, which stands for Peace and Harmony in Swahili and Aspirations in Arabic. And for me, from my perspective, everyone is involved in the impact space. Just about 90% of people are in the negative impact space. But I can unpack that more. But ESG for me is I've believed for a long time it will be standard business, but it will take us some time to get there. And we'll unpack that too.
Thank you, Deborah. We have a lot to talk. Now, Alessa, please, if you want to introduce yourself.
Thank you so much. Hi, everybody. So my background covers both the investment side and the entrepreneurial side. I also sort of came to the space more from back my academic background, being a system design, system thinker, kind of researcher, and really looking into different models of governance, comparing different governance systems around the world, and then going into decentralized technologies, ultimately with an angle on what can be more impactful than having a better system, a better economic and social system overall, which then led me into a journey where both as a tech investor, angel investor, and entrepreneur, I went straight into areas that were under the whole impact umbrella that we'll talk about today. And eventually found like a lot of room for creating more synergies. So I'm the founder and CEO of Top Tier Impact. We as a group have a global network with impact investors, entrepreneurs, corporate leaders across 45 countries. We have an investment unit and a consulting business that works with publicly listed companies on climate risk scenario planning, ESG strategy, and all the things that are kind of part of this new paradigm.
Hans, please.
Yes. As you can see, my name is Hans-Bernhard Meyer. It sounds very German. It is, in fact. However, I grew up most of my life actually abroad. I started my young ages in Paris, later in Brussels, and I worked professionally after my studies in London. So I can call myself a really international investment banker, because I was working for Morgan Stanley for more than 12 years and later for A.T. Kearney. The last 10 years, in fact, I have been working in private equity and in venture capital. I have my own firm, which is based in Belgium, which is invested, and I invest in B2C, companies, which have in a certain way an impact on with the consumer business. However, as an advisor, because I have 2 hats on as an advisor, I advise lots of startups who come to me and ask for advice. One either for the equity story, which brings us exactly to the subject, where they have to try to define the value proposition with their project to the investors, and it leads automatically to the discussion about the impact a certain project have. And I'm sometimes I'm quite how would I say angry in a certain sense, because now every startup which you see on the planet, I suppose, is pretending to have an ESG impact. And in most cases, in some cases it's definitely true. In some cases it's just an alibi, to paint oneself green, to raise money, or trying to raise money easier. But that's something which we're going to discuss, and I'm sure it would be interesting to see how my colleagues see this. But I have clearly seen this many times, and entered discussions with the project leaders about their mission, which sometimes is not actually a mission, is just pretending that they have an ESG. So I'm more than happy, and thank you very much for inviting me to the panel discussion. And perhaps we can discuss this a little bit controversially.
I love it. This is why we are here. Now, I don't mute myself, otherwise I'm going to, again, talking without you listening to me. So if there's some noise on my side, I'm very sorry. I'll try to do my best. Let me move to the next one. And please, Yasin, if you want to introduce yourself.
Hi, everybody. My name is Jazeel. Just a really quick background to myself. I work currently for a global pledge fund focused on investing in climate tech companies. I was born and raised in Ghana, lived a bit in America, lived a bit in London, kind of doing everything from investment banking to working with growth stage companies. And I think, like Hans mentioned, there's a lot of conversation out there about what impact investing is and how to really determine what is real and what's not. And I'm super excited to be a part of this panel and hear and learn together with everybody else on what the impact investing space is, how I've seen it work, and different ways in which we can maybe learn new things together.
Thank you so much. The last but not the least, Zuben, if you want to introduce yourself.
I'm Unzube Ifodike, based here in London. My background is just as varied as a lot of the members on this distinguished panel. Started as a technologist before moving into finance, and my introduction to impact was at Wyra UK, corporate accelerator, where I was the financial inclusion program manager. We had an accelerator that focused on financial inclusion, and as you know, that is squarely within the impact space, but it wasn't in Africa. It was up in the north of England, in Manchester. But fast forward from 4 years ago when I did that role, I've held several roles within the sort of intermediary space, supporting and accelerating companies that are focused on impact. I am also an angel investor, and within that, I tend to have an impact on with the lowercase I, and it's more around the S, I would say, around the social. As you all know, are fully aware of the disparity when it comes to fundraising while being a person of color or while being female. So most of my portfolio companies as an angel investor are within the diverse category. They're creating companies that are world-class, disrupting multiple sectors from gaming to education, but just that the founders happen to be slightly more underrepresented. And through my investment hat, I'm a member of a couple of angel networks that focus on diversity. For instance, Armor Angels, which backs female founders, and Hope Fund, which looks at more African-based founders. So that's me in a nutshell for this. I'm looking forward to unpacking a little bit more the range of impact and to learn from the rest of the conversations. Thank you.
Thank you, Zubin. Thank you very much. I'm very excited. Let me prepare myself, and let's start with. Now, before we start with topics, there are 7 topics we can pretty much include in 2, maximum 3 macro area. The first one is exactly what Hans was talking about. What is a real impact investment? Because I'm asking myself, actually, I'm not the best guy to talk about impact because that's my area of where I know the most, but everyone is talking about impact. We talk with startups every day, but I'm really still asking to myself, this is why I decided to do this very beautiful session today. And I would like to Hans, if you want to take this first one, what it looks like a real impact investment on your side? What do you think?
I would say a real impact investment is something where, in fact, it's the core business. The business model is built around an impact which will change ways of production, of selling, of distribution, whatever you name it, and you have a, let's say, in before and after. And that before and after is clearly defined. It's either a better technology, a cheaper technology. It is saving, let's say, resources. It's saving time. It is less stressful, and so on. You know, there's many examples, but it is clearly a before and after. And that before and after can be defined. And because it can be defined, you can put a value on it. And because you can put a value on it, you can make a value proposition to investor. That is, for me, an impact investment. If it's just a project which would have been done anyway, and you know, and they're trying to find a green angle by saying, well, we might, our technology might also contribute to saving fuel or cleaning the sea, or whatever you name it. We have all seen this. For me, that's not an impact investment. Impact investment, as I said, is, for me, it's a before and after, which is a now, and it will be, if you want to define it clearly, more precisely, which is a now and an after the project, where you can see the difference. This is the way I would say is an impact investment, which would let's say, persuade me to look at to qualify it that way.
What do you think, Deborah?
So I agree in principle, but there are some caveats where I look at it a bit more broadly. So I made reference to everyone's in the impact space, and a lot of people, so let me give you a specific example of what people really miss. So a lot of people think that Tesla is positive impact, but what they're failing to do is looking at the impact throughout the supply chain. So if you look at the impact from on an E perspective on the environment, from mining of lithium, and also at the end of life from the waste of the lithium batteries, then you're actually into negative impact. And so when you do a compare and contrast to other alternatives, is it really a better solution? I mean, just a silly example. I was behind a Tesla today. The guy changed lanes without indicating. If you really want to have autonomous cars, you actually indicate as a natural thing. Yes, it is about before and after, but if you look at it from every single business is in the impact space. Facebook, as an example, had a before and after. And one of the things that every single entrepreneur needs to do is have a very harsh look at their business and the consequences, and make sure that they are mitigating any potential negative impact, and taking responsibility for it, not kicking it down the can. So it starts with a mindset and an attitude of taking responsibility for and recognizing that every single action we have has a potential consequence, and mapping that in and factoring it in and being upfront about it. Does that answer your question?
Of course.
May I react to that? What Deborah was saying? I mean, she's
Yes,
absolutely right.
If you can, Hans, let's make everyone give their voice, and after we can discuss on top of it. Everyone can discuss. Okay?
No problem.
Zubel, if you want.
Sure. Yes. Just a couple of comments to add to Hans and Deborah's statements. I think when I try to quantify impact, a simple framework I use is the UN SDGs, because you have those labels across multiple 17 different buckets for what I would consider impact. I know sometimes it's gray when it comes to certain jurisdictions. For instance, in some emerging markets, most would consider any activity to fall under impact, which, you know, that's a debate in its own right. So I'll say that it does depend on, for me, if it can fit into one of the UN SDG buckets. The measurableness, if that's a word, of it is important. I think there are lots of people working on ways to better quantify impact, across supply chain, across institutions, etc. So from my perspective, I think that's an easier way to bucket it is under the UN SDGs.
Joseph.
Absolutely. Perfect. Thank you again, Max, and thank you, everybody, I think, for going and showing different parts of what it means to be a real impact investment. I think all three positions really kind of falls into how I like to think about that. I think of impact investment more like a kaleidoscope than just one thing. I think that if we look at it from different angles, we can find different spaces in which we can continue to add value. So the working definition I normally use as I think about it is the additive measurable effect, right, of a particular, either an investment or a non-cash injection into a solution that is focused on solving at least one or several of people's specific people's pain points. And I like the measurable part that Nzube brought up, because I think to define what is and what is not real impact investing, we can get really philosophical and kind of like scream back and forth each other about which parts of the measurement is important. But I think more important is the actual outcomes. Can we really prove that this is impacting people's lives in a way that is not only measurable, but also repeatable? So like if you impact people's lives one-off and nothing ever happens on it again, is that really real value? Able to create a value that impacts people's lives and continue to repeatedly be a positive add? And that could be, like Deborah said, look at the entire supply chain and really understanding from sourcing to waste, where can we continue to add value? That could also look like, Nzube said, investing in underrepresented founders who may not have the same access to capital in this space. I think when we think about impact investing, it can get very easy for us to want to pigeonhole ourselves into one specific definition. But I think if it's measurable, if it's repeatable, then I think we can define that as impact investing, depending on what kind of angle you come from it and what level of involvement you have in the industry.
Alessa, if you want to give your point of view, and after we can absolutely discuss on any.
I think at this point, something useful to do, guys, would actually be to draw a comparison to a couple of like the main words and definitions that we have out there. So if you think about ESG investing, that is mostly on public markets, it's about not doing bad and meeting certain minimum criteria. Impact investing is about doing good and obviously introducing a measurable and quantifiable component. Now, there's a lot of different frameworks out there. And I think a couple of things that are worth mentioning right now would be the concept of additionality. And so the dollar that you put into a certain investment, would that dollar come anyway from other funds, from other markets, from perhaps non-impact focused funds as well? And so a classic example would be companies in the alternative meat space, where valuations have grown a lot in the past years. And so whether you're an impact investor or not, it doesn't matter, because those funds come anyway. So that's one thing. And then the other part that I think is interesting here would be to think a little bit about root causes. And so going to the root cause of a sector, an area that needs a certain impact and has already certain goals to be achieved that are clear to everybody. One example is the SDGs, right? Like it's clear to everybody what these core targets are, but going to root causes effectively means differentiating a little bit between giving the fish and teaching how to fish. And I think that this is a frame of thinking that can be applied to pretty much every sector. And the last thing to mention in this, because we could talk about many different angles and many ways to cut this cake, is to think about the systemic approach of all of this, because there is not right now a ledger that counts what it means to, poke and push this button here that looks like it's positive impact. And Deborah mentioned before the case of companies like Tesla, where you're not necessarily looking at the full picture of what are the emissions in their scope 3 supply chain, which is like a much deeper way of looking at the supply chain of a large company and understanding if they're being positive or negative and how negative they're being. But really, it's actually looking at the full picture of the data and the interactions among companies and understanding, like, if I touch this, is it going to be good or bad, like on the other side of the world or in this other industry? because a lot of things that are done in a well-intended way and might on the outside or on the surface look like, oh, there's going to be a positive impact here. It's clear, it's measurable, it's tangible, might actually have much more of a negative repercussion somewhere else. Now, I'm saying this, and it's not like we have a system right now to really measure like negative externalities or positive ones, but it's certainly something that is worth keeping in mind as we move through frameworks and update these frameworks such as the SDGs and just ESG in general.
Thank you, Alessa. Hans.
Yeah, let me react to what Deborah was saying, and also Alessa. I mean, as a trained economist, this is not new to me in a sense, because in university you learn that you have a macro view and you can have a micro view. So a new product, a new technology, whatever, a technology advancement has a positive impact on society or positive impact on environment. But at a closer look, all of a sudden you realize that it has also, there is a macro view, and the macro view can be much less positive than it looks like. This has been around for the last 200, 300 years in economics theory. So from that point of view, I think that's nothing new. It's called collateral damage in a certain way. And even if I take the example of Facebook, I mean, Facebook looks like having a positive impact in one sense, but I mean, how many families it destroyed, how many relationships it has destroyed, and what impact did it have on the development of children or of young people? So that can also have a very negative impact. So it is obvious that one has to look at it in a closer view. But if we are all investors, and this is what I do in any case, is there is the project which is presented, and then of course, since I've been trained on this one, I also always look at the other side of the coin. I try to turn the coin around and say, hey, not only, wait a second, is this really a positive impact you're pretending? And what are the negative consequences? Because the negative consequences, if they are actually, if you omit to see them, they will come up one day. They will come up. It's like a ghost in the closet. It might be a legal problem. It might be a logistic problem. It might be an environmental problem. So as a good impact investor, it is obviously, if you do your diligence right, that you always look also at the negative consequences of the project you're presented to. And all of a sudden you find that many of these projects, even if they pretend to be having a positive impact, all of a sudden don't look as positive anymore or less positive. And then one has to make a decision if it's really worthwhile investing or not investing.
Thank you, Hans. If anyone else wants to add, please.
May I say something super quick? So Hans, I'm really glad you brought up those points, because you're right. The thinking has been around for ages. And the reason I bring it up, and I always harp on about it, is because one of the pushbacks to ESG, for instance, is that there is no one single unifying model. And that's just a cop-out, right? Because if you look at it, if you look at, for instance, banking and investment bankers, they're among some of the smartest people in the world. They come up with models all the time. They're massively creative. So this stuff about there being no model is just BS, right? So this is why everyone's in the impact space, and anyone who is saying otherwise, it's intellectual dishonesty.
Yes. And a well-made, a well-tailored Excel sheet is not a proof of an impact investment neither.
Just say it, Sube. Alessa, if you want to add something, please do it. Otherwise, we move to the next one. Let me. They are all pretty much correlated. Now, we are here. We are in venture capital environment, so we talk about startup primarily. So are all these startups claiming to be impactful, really impactful? Because myself, I've been really, again, I'm not the best person who can judge this, but I've been receiving so many decks where myself, I can see an impact. So my question to you is, how are all these guys really claiming, okay, I'm impactful because maybe being impactful gives me some good funding? Are they really impactful? Hans, please.
Well, I've been saying this earlier, I think a couple of minutes ago, is if somebody comes to me and says, I've been working, or we are working on a new technology, our team is working on new technology, and it's going to have an impact on cleaning the oceans, for instance. Although I'm not a trained physician, and I'm certainly not an expert in these kind of things, but at least I look at it if I'm interested, and I spend some time on it. I look at a little bit closer, and I'm really looking. I'm searching for, of course, the impact which they present to be, and then always, as I said, as a trained economist, I also look at the possible collateral damages they're creating. And so in most, I would say that there is no investment which is around where you can, unfortunately, this is the problem of human mankind, which is, which is 100% positive, and it is a question of making a decision to balance the arguments, the pros and the cons. And it can be a political decision. And for an investor, it has to be an investment decision where you can see if the negatives in the long run, or if the positives are going to outnumber the negatives in the long run. And if that is the case, how much money can I make in doing that period before the whole thing explodes or becomes difficult, or needs some more money? That's basically it. It's a pragmatic approach, but one should certainly not just believe what these pundits are saying about impact investment is going to change the course of the world or the course of humanity. We have seen this many times, and we all know this, like the social medias, the Facebooks and the Instagrams and everything like that.
Super. You are an angel investor. I met you exactly 3 years ago because we'll be doing something together in same environment. You've been talking with so many very early guys. So what's your take on this? I mean, how really can we understand and we can measure how really a startup can be impactful, good impact, bad impact, or zero at all?
So the measurement is one that's hard to do within the startup space because they're still trying to figure out product market fit and other aspects of getting from 0 to 1 and then scaling. However, I mean, there's some frameworks, I think Tide have an interesting framework they have for measuring impact. Within the startup space, I just look at those high level summaries. So how much of an inclusive society is that particular project going to do? Is it tackling things around UN SDGs? I've already alluded to those. So food, energy is another key area within emerging markets. It has that multiplier effect. Once you are able to provide energy sustainably with less impact on the environment, then obviously that unlocks a lot more capacity and development within several countries. There's been a lot of capital flowing, into environmental type impact projects on the back of COP26 and all the commitments. But what's interesting is even though the conversations have focused on renewable energy, that scope of what's permissible has obviously been extended recently in light of geopolitical events. So gas to liquids, coal, and other forms of energy are being included in terms of areas that capital is still going into to diversify access to energy. Because if you're looking at that broader picture of where energy comes from in this case, and you're looking at that supply chain, if you're looking at actors along that supply chain, you want to mitigate certain types of geopolitical activities. You all know I'm talking about Russia, Ukraine. I don't need to be subtle. But yeah, so when I look at startups, it's primarily those big ticket items, building inclusive societies, helping on aspects of the UN SDGs, or having founders themselves that have been historically excluded from access to capital, because that then expands and builds a wider pool of talent that can then lead to more development in certain communities.
Alessa, let me know your point of view.
So obviously, this depends very much on the sector that we're talking about, and every sector has its unique ways to look at where do you draw the line. I think that ultimately, as an early stage investor, there are a couple of things that I wouldn't compromise on and that are quite universal across the impact space, because quite frankly, the moment that you have a unit of measure that makes sense to quantify the impact, and it's pretty clear that it's positive, even though, again, it's within the limits of understanding like what the effects are going to be, the secondary effects of that, then I care about scale. And I care about scale both because, like, as a business, as a startup itself, obviously it makes sense on the trajectory, right, to analyze the scale, analyze the market trends, but ultimately because that's how impact can truly be delivered at scale. So in other words, if there are 3 business models that all seem to have a similar and reasonable unit of impact account, the sort of like filter that I'm going to apply is which one is going to scale more. We're also talking about investing and not philanthropy. And so both in terms of that impact actually scaling and multiplying much more, and therefore like, being more impactful on the net and the financial returns, they both align and it makes more sense. And there's an interesting example that I noticed recently with one of our members at Top Tier Impact, who's an institutional investor focused on gender lens investing, and on the side has been setting up a philanthropy in the education sphere, a little like a nonprofit to re-educate women in South America that have been victim of sex trafficking, abuse, and looking at retraining them with companies that would give out of their CSR budgets. And we were talking about like the specificities of the model and how it can scale. And ultimately, when you're going after CSR budgets, as opposed to, let's say, what those companies truly need in a competitive market to hire as many of these women as possible, you're suddenly talking about a for-profit instead of a non-profit business. Now, I'm not saying with this that everything needs to be for-profit, because some areas just don't work for that for various different reasons. But in that case, we like clearly understood that to have the most impact by you retraining and employing as many women as possible, then the model had to be as competitive as possible as well. And that meant looking at, rather than the path that they were going down, it meant looking at the competitive dynamics of what does it mean to train horizontally. So in other words, not training vertically for specific, let's say, computer scientists that are highly qualified, but training horizontally for a competitive rate on the market that companies are going to be happy with, and jobs that can be delivered remotely in a digital environment. And so it's just an example where the solution that seemed to make more sense was the solution that obviously had more skill. And so I think that while every sector has specific ways to look at what is real impact and what is not, and ultimately what are the systemic challenges in that sector to move the needle and shift into a sustainable paradigm, then scale is a big one.
Thank you, Alessa. José, what do you think?
For sure, and thanks everybody for sharing your thoughts. So by virtue of my background, I've worked in philanthropy, been a banker, now I'm an early stage investor. I've got a chance to see different models of how people think about impact. And I think the only way to answer the question, all startups claiming to be really impactful, is whether or not you can measure it. I think like Nzube said, in early stage investing, they're still trying to figure out product market fit, just trying to run a business. So as an investor, what I look at is impact baked into the startup's business model. So I'll give you a good example. We just did an investment into a waste management company that is focused on improving recycling rates in sorting facilities. And a company like that, even though they're still figuring out how to measure it and track the impact of their solution, we're able to see that the focus on impact is all the way through their business model. That oftentimes gives me the first inclination to dig in a bit to understand whether or not that impact will eventually be positive or negative. So I think that in terms of like when we think about whether something is really impactful, you have to get a step back and consider what is the motivations of the capital. So I think like Alyssa was just mentioning, in philanthropy, there's a different focus in which they think about impact. There's an early stage investor who is investing also for returns as well as for impact. And even within investors, it's impact first investors, profits first investors. So I think the number one thing that we need to think about is, can we measure this thing? If you tell it to me that you, and I think use Hans' favorite example, if you say to me that you clean oceans, which is a great example, how can we measure that? How much tons of plastic are you repeatedly taking out of the ocean? What are you using that for? Can we measure that impact? I think for me, that's really when we can start to make the difference between people who actually have impact and people who are spinning a really great story to raise more money.
Thank you, Jose. Deborah, I just left you.
Can't really add more than what everyone's added. There's one thing though that worries me, and someone actually brought it up in the questions, and that's hype and biases. So so some people, for instance, are using a lens for female founders. Okay. Theranos is a great example, right? And the thing is, there's of how that bias can go horribly wrong. But the ingredients of the hype and spin around Theranos are, I think, poisoning the ecosystem. And the reason I look at the broader ecosystem, not just impact, is because if there's all this focus on unicorns and there's this much focus on impact, we're muddying the water. And we're also muddying the water when, we've got social entrepreneurs as another little subset. I was listening to a UN speaker once with a panel of social entrepreneurs, and he's like, said it's because of you that we're going to reach a clean planet. Well, we're going to rely on social entrepreneurs to reach a clean planet. We're in really, really big trouble. So Alessa makes really, really good points about the systemic change and going back to cause. So you can have these strategies of cleaning up the oceans, but we need to challenge business as usual. And that's why, I repeat again, everyone is in the impact space. And the quicker everyone gets with this program, our future generations will have a world that they actually want to live in. There's a lot at stake. And it's not, we have no sense of urgency. Someone mentioned COP26. That was a complete cop-out. One of the things I did predict out of COP26 was there's going to be a huge uptick in the demand for ESG and sustainability specialists in funds and in companies. But that's not going to solve the problem, because if you don't have CEOs and boards on board as well, those people are going to be burning their time. So we hear about the negative impact of burning fossil fuels, but burning human time is actually worse than that. We have a limit on methane emissions, and I think there's a lot of methane coming out of people's BS. Anyway, kind of went off point, but but I think it's an important point to make. Everyone is an impact.
Thank you, Deborah. If anyone wants to add something, please.
Yes, I want to quickly. Sorry, just to comment on a few topics raised. So I agree with Deborah that everyone has to be part of this conversation. It's not relying on certain types of operators to address the global problems. But also I wanted to touch on something that Jaziel and Alessa said around sort of for-profit, non-profit, and philanthropy, because I think there's a real opportunity here for the for-profit, large organizations, startups, scale-ups, etc. Whatever domain they focus on, there's an opportunity to work and collaborate closely with the non-profits. And not just by making donations. I think that's a little bit lazy. When it comes to the non-profits, they have done certain things right, in terms of, having that genuine connection with the community, having some distribution network, that trust factor, and so many other things. And the for-profits, are good at, creating some degree of efficiency and allowing for value creation. So if a collaboration where, it's not about returning capital to shareholders, but returning capital within the non-profit to sort of scale up the impacts that the non-profit has. That's where I think there could be a lot of opportunity to work together, because many non-profits like to think of profit as a dirty word and would rather just lose money each year and not maintain a certain level of fiscal discipline. So I think if a for-profit partnered up with a non-profit, then that level of fiscal discipline, with the main difference being no cash is returned to external stakeholders, but that cash is used to amplify your unit economics makes sense, and the cash is used to amplify the good work that you're doing.
Justin.
Yes, for sure. And Izube, thanks for that point. I think I just want to bring us back to a couple pointers that have been raised. I think the first one is kind of this interaction we have between impact and investing. I think Deborah mentioned a really good point around like focus and biases, and whether like the Theranos example is muddying the waters of like raising money as a woman, which there's an argument to be made. But I think as an angel investor myself, with like Zugu, who's only investing in women and diverse owned businesses, I think that I agree that everyone should be in the impact business, but I also think that to expect all of us to do everything for everyone is not realistic. And I think like, especially with regards to like focusing on founders and people who are thinking about solutions, that may not get the attention of your classic nonprofit and your classic grant maker, your classic investor, because like we have all the numbers out there, and I speak as I sit in the investment house, I speak on investment. We have all the numbers out there, how many women and people of color don't get funding. So I do think that like the impact conversation is one that we should bring. I agree that everyone should be an actor and everyone should be involved, but I do think that like there's the conversation around impact needs to be a lot more nuanced than everyone needs to be involved, because we cannot hyper focus on one thing or the other, because there's some people who by definition are not getting attention, capital, dollars, focused on their issue that are just as necessary and just as impactful as like methane. And I agree that methane is really bad, but I also agree that like education gaps in Black children is even just as bad. So I think that, but we have different investors and different actors who can focus on different things. So yes, we might depend on some social entrepreneurs to help us figure out how we can treat the mangroves in Puerto Rico better, but we also have a nonprofit that who can think through how to, upskill women in engineering. So the conversation around impact, I think we have to remember that there's a bunch of stakeholders at play, and it's less a matter of can we get the right solution done, and more a conversation around how can all of us interact and interplay so that we are moving forward this idea that additional dollars should make additional impact in the world that's in some way that we can measure. I think that's kind of just want to share that.
If I could just clarify, because I don't want Theranos being taken out of context. It's all I'm stressing is there's a lot of hype and noise in the entrepreneurial ecosystem, and that does not help anyone. We burn a lot of cash. I mean, the failure rates are astonishing, and then the good ones, because either they're quiet or what have you, get overlooked. So that needs to be recognized, because we're having negative impact by deploying our biases. And the second point is we need to get out of the silo mentality, and we need to understand the concept of building ecosystems and identifying synergies, which you have all touched upon. And that is a model that it's one of the only ways to go forward, because if you you solve a problem for someone, you create value, and sustainability, you've got to be financially sustainable as well. Money is not bad. It's how you make it and what you do with it that determines whether it's good or bad.
Thank you, Deborah. Before we move to the next one, everyone wants to ask, please write in the Q&A so I can read, and probably we can't, because we already have some. We can't answer to all of them, but I'm trying to do my best. Now, I really want to stress this one, ESG. I mean, all the big corporations, wherever you go to read, this is beautiful. I mean, if you read, they are doing so much good. The reality, they don't do anything. From oil companies, which are the biggest by far, still the biggest in the world when it comes to impact in a negative way, to everyone, they claim but they do nothing. And that's the reality. They do nothing. So where are we going with ESG, environment, social, and governance? Where are we going?
Massimo, may I just react to that?
Yes.
I don't agree with you. I don't agree with you. First of all, I think we are drowning the fish here. Every investment, every step in human mankind, which has been done by great, by a new invention, had an impact, and it moved forward humanity, it moved forward society, whatever it was. And the negative impact of such an investment, they came often later. And when mankind realizes, or society realizes, is there's many possibilities of basically reducing them as well. And if you think about it, you're saying that the oil companies, as you know, are doing bad. Fine, that's one point of view. On the other hand, if they would stop producing, fuel for all of us from one day to the other, everything would stop. The logistic, everything would stop. In fact, people would starve. Okay, so the impact of such a decision, and we can see it with the war now, would mean there will be famine, there will be starving, there will be areas in the world which are starving. So one has to look at more precisely in an economic way, and not just as Deborah was saying earlier, or Ernest was saying it earlier. We have to look at it with a cool heart, with a cool head, and look for the positive impact of any investment which has been done in the last 1,000 years against. For me, this ESG discussion is a lot of hype, because at the end of the day, it's nothing new. It's nothing new under the sun. Specifically, if you do your diligence in a proper way, you will always realize that everything you do has a positive and a negative impact. And it always boils down to, are you willing to do live with the negative impact in a certain way, or are you not willing? There's nothing in there's no investment, I would say, which has only positive impact, because even working, if you want to produce machines to clean up the ocean, they have a carbon footprint by during the production. So please, let's be realistic. Let's keep a cool head and not just, put everything and say that everything has a bad impact, even if it's just because it looks like it.
No, yeah, absolutely agree. I will take just 1 minute after we talk to you guys. There's not my role to talk today. What I want to say is the disparity between how much do we talk and action is very huge. And ESG is very much, for example, for consumer goods company, is very much used because you need to communicate that you're doing something good for the world in order to people to buy your products. And I stop here because there's not for me today. So Alessa.
I think there's just a very natural trend towards specificity, and depth. But when we look at it from the lens, let's say, of companies having to report on ESG and investors in public markets asking questions on ESG, let's not fool ourselves that there is a huge issue with the fact that the data is not online. Like, most ESG data is either not available, cross-departmentalized, or however you want to say it, stuck with the suppliers. It's actually very difficult to get granularity right now, unless it's done, managed, and collected over time in a certain way, and then also analyzed accordingly in the picture of the company. And so the reality is that most of the data and the ESG reporting that we deal with is extremely superficial, because there is no other way to do it right now. And this is something that we see day to day with the companies that we work with on reporting around that. Climate risk scenario planning, nature-based reporting is coming as well. So that's biodiversity, basically water, everything. Regulation is really cracking down on this. But the reality is that there is a massive catch-up to do. And that catch-up on one side pertains on the expertise in these markets, right? Because when you have consultancy firms saying we're hiring 100,000 ESG experts, there's not 100,000 ESG experts out there. And there's also not a lot for them right now to analyze. And so these markets just needs to go through developments in the next few years that are just going to take a coordination across the ecosystem, various different tools. I mean, we have SaaS that we can now use for these kind of like data collection for what we do, because it's just not been available out there. It had to be created and put into the market. And so, you know, I just think that to get to the depth that we ultimately want to get to not fool ourselves around some checkbox exercises, there's much more that needs to happen for that to even be possible. And that is a process that we all need to be part of from different sides of the same issue.
Thank you, Alessa. Before we move, actually, no, let me finish to talk. There's a very nice question I want you to answer because it makes a lot of sense. Zuba.
Just a quick one. So my observations on ESG, I mean, it's clear a lot of attention has been given to the E. Post George Floyd's murder, a lot more interest took place around the S. And also on the back of COVID, it was clear that institutions that had more robust frameworks that allowed for flexible working and for, you know, greater care around their employees were a lot more resilient. So the business resilience was what made a lot more conversations and a lot more attention to be paid to the S. I think that is not as much center stage as it was a year ago. However, some communities are still receiving some, you know, pounds and dollars. Where do I think it's going? It will be interesting. I think that's anybody's guess, but I'd like to believe that around governance, you know, investors do want that governance framework to remain in place in order to have the right sort of financial frameworks, the right, you know, practices, reporting, etc., to make sure that they can feel more confident when they report to their LPs what their portfolio companies have been up to and what systems they've got in place to manage that value creation. I don't see that disappearing anytime soon. However, I think the attention that will be laid on any one of those just depends on what macro conditions or geopolitical factors exist.
So business continuity is S and it's G. And I want to touch upon oil. I'm sitting in the Middle East, and so it would be remiss of me to, and I was raised, my father worked for the Aramco when I was growing up. It is very naive of people to want to switch the taps off overnight. From an S perspective, the level of negative impact from an unemployment perspective would be disastrous. From a funding perspective for the rest of the country, it would be disastrous. And there's a correlation between youth unemployment and social unrest. We have to recognize transformation takes time, but we all need all hands on deck to make sure that we course correct the trajectory that we're on, because this focus purely on returns without factoring in consequences is taking us down to, like, it's taking us to an iceberg, using the Titanic analogy. So whether you want to call it ESG or impact, it doesn't matter on the term. People, purpose, people, profit, planet, right? It's not rocket science. Otherwise, you're a psychopath.
Jazzy.
Absolutely. People, profit, planet. It's exactly right, Deborah. I think for me, when I look at ESG, what I'm starting to see is there's a lot of talk. I think we all talked a bit about the hype and like how much all these fancy, flashy announcements are. But I think if you look closely, there are people, several actors really across the value chain who are doing really great work. And so for me, I believe the future of ESG as we see it is going to get more specific. Like Alyssa mentioned, I think that the data that we need isn't out there yet, but there's a lot of very smart people working on it. And I think that that really is what underpins the core of what impact investing is. It's not going to be an easy journey, I think that, but it also didn't take us overnight to get to where we are. We've exchanged money for resources for as long as we can remember, and have kind of just grown with disregard to what the impact or effect was. I think we're starting to get to the beginning of a transformation. And I think Deborah's example of the Aramco point is exactly right. I think that we're looking at different ways to transition to renewable energy, but we're also having to think through what happens to the people who we transition out from fossil fuels, how to reskill them. Those are all different spaces. And I know, especially in the oil space, a lot of people are thinking through different solutions, different people, different actors in this space. So I'd say that right now, ESG, we're at the beginnings of it, but I believe that's going to permeate into broadly as wealth changes hands and as we continue to, for the ones where we have an earth that is dying, we're going to more and more people are going to care about this. The hype will probably increase exponentially, but I think the work that people are doing on the ground is still very real, still very prevalent, and we get to the pleasure of being investors to support them in those dreams and be able to dream a bit and reimagine how the world will look like. So for me, I think ESG, we're at the beginning, but I see it definitely permeating. And eventually, like Deborah loves to say, we'll all be the social entrepreneurs who are focused on impact.
Can I just make a point about data? Because a few people have brought up that there's no data. I need to remind everyone that the amount of data companies have on us as individuals is crazy. So this is a challenge to all the entrepreneurs out there. If you or you come across anyone who is weaponizing technology in the same it was done on the common man on companies to get more transparency, bring them forward to EquityMatch. And I would love to screen them. I think Hans would definitely join me on that screening panel. The solutions exist. We need to hunt them out. If you're quiet, speak up, come forward. If you haven't quite figured it out yet, come to the table, let's roll up our sleeves, let's find solutions, because these are meaningful problems and we need all hands on deck.
Thank you, Deborah. Let me read this question. Planet Super League conference call. There is some issue I'm struggling with on impact investing. Inequality is a major cause of social and environmental problems in society. Impact investors seems mostly to be pursuing unicorns. Each unicorn creates more billionaires and more inequality. Then the return needed, IRRs 30% or more, put even more pressure on the planet to deliver up resources to give those returns. What's the answer? Hans, you want to take it?
No, I wouldn't. First, I mean, unicorns. In the end of the day, a unicorn is the team of a unicorn, which creates a unicorn in the sense, they're rewarded for their risk and they're rewarded for their work. Okay. Now and inequality is something which is it's a moral judgment. I mean, inequality. Everybody, we are all not equal. You and I, we are not equal. All the panelists, we are not equal. So from that point of view, you're saying, well, we should be equal. I don't want to be equal with you guys, and you don't want to be equal with with me. We all need our differences, because the differences is what makes us productive. And as Jazil was saying, social interaction is between human beings is because is based on that one, that we are not equal. If we would share everything with the same, like perhaps in China, I don't know, we wouldn't be productive. So that's the number one argument I would have. And the second argument is that one has always in a capitalist society, one has always to look at who is going, if there is a loss on something, if a company makes a loss, who is going to bear that loss? Okay, is it the banks? Is it the shareholders? Is it the employees? Is it the society? So one has to have a more focused approach to such a diagnosis, and then you can find a solution to it. But in general, put it a different way, it is easy to make a judgment without actually knowing the facts, and sometimes facts are quite different from what they look like. That makes the discussion about ESG impact in investments sometimes quite difficult and also murky, and unfortunately highly political and highly emotional.
Thank you, Hans. Let me read this one after we move to the other topics. Is it possible to invest in a company mainly on impact? And where is the balance with the financial returns? Joseph?
I think it is. I think, however, that it's not going to be a simple solution. I think that is going to require different permutations, and we call that innovation as people continue to think through how to redefine finance, how to redefine returns, and just back to your earlier question, Max, on the 50% IRR and et cetera, which I agree, it's a lot of like some investors look for. But I also think back to the point I'm making earlier, I think that we have to allow ourselves to remember that there is more than just investors in the value chain of people who are looking to support ideas. So yes, the VC or the private equity might have the IRR metrics, but philanthropic agencies have different metrics. So that's, I kind of want to highlight that. But I think back to your point, I do think that we are in a place where we're figuring it out. I think that, like Deborah said, there's a lot of data out there. There's a lot of ways we've done things very smart. And people are thinking through different ways to do it. So I'd say that we are continuing to innovate. And I do imagine a world where we'll be able to kind of marry those two disparate points.
Thank you, Jasil. I want to move to the next topic. I mean, and talking about business model, an impactful business model can be sustainable for the environment, the community, for the ESG, at the same time for the shareholders. Zuba.
Yes, of course, it can be. I'll give a simple example. One of my portfolio companies that is based in Wales. And what they do is really simple. It's in the recycling spaces, manufacturing. They collect ocean-bound plastics from several countries in Africa, continental Africa, and then these are then hot washed, created into flakes, and then brought into Wales for further processing and converted into sheets that are then used as inputs to the sort of, the manufacturers of plastics that go into food packaging here in the UK and in Europe. They've got clients in several countries, from Spain to Turkey and half a dozen other countries in other parts of the world. Anyway, the point here, yes, it's focusing on the plastics problem, but the manufacturing plant in Wales is also addressing a social need. So it's in an area called D-side, where there's a high unemployment rate, and getting people into the factory obviously improves their quality of life, giving them that livelihood. It's also reducing the for food manufacturers here in the UK. Obviously, there's a greater target around the use of recyclable plastic or recycled plastics, and getting virgin plastics from Africa. I know it might sound counterintuitive, but getting virgin plastics from Africa is a better quality grade than getting the plastics from parts of Europe where it's already been recycled a couple more times. So that allows for it's less brittle, and it's more flexible with respect to how it can be used. And this company is turning over £1 million a month, right? So it's very profitable. The margins are very healthy. The disruptions to supply chains are making it even more in demand for them to, get those plastics across from anywhere in the world. It's mopping up plastics, ocean-bound plastics, and processing them over in Wales to feed that whole supply chain. So we're not picking like profitability versus impact. It's both. And I think each one on the panel has at least one example they can talk through where you can have impact on multiple layers, as well as really good profitability ratios.
Deborah.
You have to have both. There are great examples. There are two. I mean, there are so many amazing companies I come across, and I'm a pedantic pain in the butt when it comes to this. Two companies in particular that come to mind. One is Good On You, that is a fashion rating app, and it looks at just check it out if you're interested in ethical and sustainable fashion. They tackle that, and they partner with some major players such as Farfetch, etc. And they recognize it is a path. You can't do everything overnight. The other one is an early stage one out of Australia, which is called DigiSocial, which is teaching children how to interact online, how to be good online citizens. So they're tackling the problem. So the founder comes from a child development background, and she was shocked by the mental health and the uptick in suicide rates among youngsters. And so she created this platform to solve that problem. They've done well in Australia, and they're actually now scaling into the UK. So I should put her in touch with you, Max. You'll love her.
Thank you. Hans, what do you think?
I think, I mean, it's a very old, within capitalistic market society, and even probably Romans and the Egyptians, it's, you know, if you're an entrepreneur and if you take initiative and you see that you can make some money, either by trade or by producing something, and there is at the end of the day, or at the end of the month, or at the end of the year, there is a surplus about what you've been selling and what you have been producing, people actually go for it. The problem has been, which is, this is so obvious, and this is actually what we all do. Even you, Max. I mean, you don't do this because you do this because you have a certain idea behind. You want to get communication. You want to have exposure, which is great, and there's nothing wrong with that. The question is only, if things get blurred. And taking the example of Jaziel with the plastic recycling society, they probably do this because it's hugely profitable, and because it's hugely profitable, it's a good thing. But the question, and on top of it, if it's an impact investment, and in fact it's an environmental investment, which is great. And 20 years ago, it didn't exist. Now it exists because the oceans are basically polluted. So, but my thesis would be the entrepreneur who did this, he was not, guided by some religious ideas. He was guided some capitalistic ideas, which is great. And I applaud for him. And so there is not always, or there is in rare instances, there is a contradiction between profit and the impact investment. I have an example. I'm working with a curative society on trying to set up projects, home projects for homeless people. And at the end of the day, is if you speak to the real estate investors, they will all say it's a great idea, but at the end of the day, we were going to have a loss. Why? Because they don't get the rent. Homeless people don't pay rent, and at the end of the year, they have repairs and so on. So what is happening is in the balance sheet there is a loss. So the real problem is not finding a home for the homeless, which that is as real estate problem, is how to deal with that loss. And we're working on the different solutions. Perhaps some banks, it's basically trading that loss, which is actually real in the balance sheet, into a positive communication message, so that a company says, we have a loss, but at the same time we are sustaining homeless people in a certain city. And all of a sudden, this is not, it's a loss, it's a financial loss, but it's a social profit for them. And to pursue and persuade these people that their financial loss, if you do it right, you will have actually a community profit of it. They will do it and they'll finance it. So is there a contradiction? No, it is only you have to find a good step forward of trying to solve that problem, which is sort of a I would say of a economic knot, spaghetti knot. You have to untie that spaghetti, and all of a sudden that problem, which is a loss in the balance sheet, becomes actually an positive image impact for a company. They buy positive exposure. And that's the idea behind it.
May I just kind of clarify something that Hans is saying? So what we're looking for actually is not tech innovation, it's business model engineering and business model innovation. Absolutely. That's the next big thing. And it's going to be, that's so inspiring. That's awesome. Thank you, Hans, for bringing that up.
Alessa.
So I think it's good to be a bit more specific as well when we're looking at, is there financial returns, like is there impact, because there are 50 shades of gray of how much impact and how much return there is to be found in models. And so there are models, vertical sectors where it's high impact and high returns. There are others where it's medium and high, and the other way around, or low and high. And so I'm saying this also because I think as an investor, it's very important to understand where you're playing and why. Because for instance, like if I look at high on both sides, which is obviously like the most competitive vertical, then, you know, in my view, there is a real advantage to be had there as an investor, for instance, when it's deeply technological. And so deep tech, renewable energy, to just actually have an advantage that is not quite there yet in the common like understanding, because otherwise if it's out there in a more common understanding way, then we're back to the concept of additionality, where everybody wants to invest $1 in that company anyway, like let's say alternative meat and other verticals that they might have positive impact that is measurable as well, but everybody wants to invest there anyway. Right? So it's important to actually define this and be clear and upfront. Ultimately, sustainability can be understood as better resource efficiency or pollution controls, like both are drivers of actually better bottom line results. And a lot of companies that, let's say, in more industrial or chemical areas have become fully sustainable and have measurable positive impact out of that. Now we're talking specifically about sustainability and resources. Rather than social impact, but like in those areas, like it's really actually been driven by cost and improving on cost. But I think that in general, of course, like the two go hand in hand and can go hand in hand, but it's a matrix. And so it's important to understand where one is placed, for instance, high impact and medium to low returns. And that is actually just like making the case for ultimately performing better investments and ultimately just like managing a portfolio in a way that aligns with like the thesis up front. I think high impact, high return is always going to be needed for the areas that are yet to be discovered. And to me, those are where you sort of become the first believer. The first believer is like the first one that kind of aligns with the way that an entrepreneur has managed to see the world differently and is driving a different vision out there that was just not the case before. But again, you know, I think it's important to distinguish in what bracket someone is active.
Thank you, Alessa. Jose, if you want to close this.
I think everybody has pretty much said all the things I'd love to say, but I think the one thing I do like to remind, to kind of as a reminder, is what Deborah says, that we're looking really at a sustainable business model. I think that's for us is the key. Is this repeatable? Is this different? Because like the technology, the data is there. I'm meeting with companies now that are doing things that 5 years, 10 years, 20 years ago were virtually impossible, right? But the conversation now is about how can we run businesses that are sustainable, that are different players, that are different outcomes from what we've already seen. And that I think is a lot of value in there. But to your original question about whether or not like an investment can have like impact across the E, S, and G, I think it's very possible. I think that, however, it takes a lot more innovation to build a business model that are just all three than it is to create a status quo. And I think to Hans's point earlier, people are not starting businesses because out of the goodness of their heart. They might out of the goodness of their heart start businesses, but those businesses need to run and exist based on something, based on the profits, based on revenues. And so be able to build a business that actually does touch those ESG, E, S, and G. The data is there that proves that like profits and impact, like Hans said, go hand in hand. So for me, I'm always looking for companies that are innovative and bold enough to want to question why we do the things we do in the current ways, and can we do it better in a way that is impactful across the ESG plane. And that for me often turns up something that I'm excited to invest in. I hope that's helpful.
Thank you, Jose. I'm going to close with this last topic, and after, if we have some more time, we can go through other questions. There are a few. There is a lot to talk about big difference between stakeholders and shareholders. Okay, and many say business should be more looking to the stakeholders than the only shareholders, which means profits. So can we align one day the stakeholders with the shareholders when it comes to expectations? Alessa.
Yeah, so I think that needs a model that is designed in a certain way, because right now, public markets, it's shareholder maximization, right? And so saying otherwise is just a little bit disingenuous. So you're saying that a company on public markets, which by definition in the current system, like is operating in that way, is truly aligning like in a multi-stakeholder and ecosystem kind of way. It's just not currently the case. Now, when you look at what's happening, there is regulation coming in. And there are a lot of discussions about reforming the models through which companies operate. If you look at funds, for instance, there are now VC funds and growth stage funds that are aligning their returns model, their carry with actually being aligned on delivering an impact, right? Now, that's a real commitment because that's where the real incentives are ultimately. And so, of course, it's possible, but it does require to think, number one, what you realistically and objectively, like what is the system that we're operating in today? Can we actually say that there's going to be a natural and scalable ultimately, right? Because there's always going to be some companies that have a certain kind of leadership that truly wants to have that impact no matter what out of their own values, right? Which is amazing and makes for real progress in the impact space. But if we're talking about the entirety of the market, yes, it's possible, but the system needs to be reformed.
Thank you, Alessa. Hans.
I'm not sure. Let me ask Alessa a question. Do you really believe that a shareholder in Shell or in Shell is today, is not looking at the impact of his investment on environment? I don't think so. He is very concerned that all stakeholders of Shell, including himself and the employees on an oil platform, they are all aligned. Because if the oil platform goes belly up or explodes, he as a shareholder is going to, have a big problem because his shares will go down 20%. So I don't agree with you that there is a contradiction between the one or the other. We have seen this in the last development in the last 20 years, and I'm sure there has been hundreds, thousands of PhD theses have been written about, the alignment of stakeholders and shareholders. And I think the theory of economics today is an agreement that the shareholder is as much interested as any stakeholder in a society today, and you don't need
let me ask you, got it, based on that, why do negative externalities exist?
Of course negative externalities exist, but
why?
That's normal. It always does, because even if you're breathing, you are actually...
From my perspective, no, but hold on a second, Hans. From my perspective, negative externalities wouldn't exist if shareholders are fully aligned from an ecosystem-wide perspective on respecting every single stakeholder, right? By definition, they just wouldn't exist, would they?
It's a question of degree. It's a question. I agree with you, but it's a question of degree. It is. You can't draw a line in a certain point. Yeah, it's a question of degree, and shareholders should, and they will always be watching management very carefully that they don't cross the lines to create a negative impact on ESG, as we were saying, because as we know this every day, if there is a bad publicity on a company because an oil platform has gone belly up again or whatever it was, the shareholders are going to suffer. So they have, with the advisory board, they have a direct impact on management to make sure that they please do not pollute the seas. Even if they do it in a certain way, they should. And we have seen this in the past. Management there was management was fired. There was even CEOs got fired because they didn't watch somebody. Let's say they didn't watch about a company which they part of a group of the company who was polluting some Scottish waters or whatever. We can find easily very quickly some examples. So the answer to your question is, I do agree what you're saying. You're right, but it's a question of degree.
Yeah, and ultimately degree is what you need to tackle, right? Because that degree needs to increase right now.
Perhaps not. We don't know.
I mean, I think we can quantify climate change enough to say that it does need to increase.
That is a political judgment, and it's a political decision. It's not an economic decision.
I think it's quite scientific right now, actually.
Yeah, scientific in a certain point, yes,
Mm-hmm.
of course. But if it's scientific, then it's objective, and then I mean, management is better make sure that it actually incorporates this new scientific knowledge within their business model, which they actually do. They have research and development. As far as I know, Shell does.
Deborah, do you want to add something?
Fascinating. So, look, I would love to. I'm kind of between. I understand, and I sit with both Alessa and Hans. I actually looked into this a few years ago. So, because what we're talking about is reputational risk is one factor, right? So when a company is caught doing something bad, the share price drops. But also what happens, what the research shows, is if the company does nothing, the share price is back up to where it was, if not higher, within 2 years. So I always kind of bring it back to the virtues and the vices. And until we actually manage to, control our vices and move more towards virtues, which sounds philosophical, but, I sit in emerging markets. So I look at places like India, and I can, the fuels that they're using are very highly pollutant. But I recognize the argument they make about, it's all well and good for the developed West to be pushing this mandate now, but it's going to cost them. So there needs to be a financial model from a global perspective in order to balance things out. And it's because, hopeful, wishful thinking and pixie dust isn't going to solve this. It requires everyone to be able to sit around a table. And this is where we have a problem, right? If we can't sit around a table and stop situations like with Russia, Ukraine, like absolute disaster, which Max, I really love your comments online. God bless you. We're bonkers. We need to recognize that we are one planet. And I don't mean that from a huggy perspective. I was watching the documentary on Elon Musk in space, and the astronauts saying, once you're up in space, you can see that it's one planet, there's no borders. Do you honestly need to go up into space in order to see that? You need to travel to India, you need to travel to Africa, you need to go to communities where they have no access to water. That will wake you up. Go to Malta and see the issues with refugees. It's all very convenient to philosophize when you're not personally impacted. And then, anyway, I'm ranting, but we have a lot to do, huh? And unfortunately, we have a global crisis in leadership, and that's at the crux of it. We've got weak leaders in every single country.
He does. Jazeel.
Thank you, Max. And it's been great kind of like eavesdropping on the conversation back and forth, especially with Alessa and Hans' point of view. I think for me, I sit somewhere in the middle. I definitely agree with Alessa that we need some innovative models to think through how to align shareholder and stakeholder expectation. But I do think that Hans is right, that there's been a plethora of research articles that have come out to show that the external shareholders and stakeholders are beginning to align. I don't think we're exactly at the perfection point, and that's why, again, to Alessa's point, we have negative externalities. But I do think that, like, as the flow of generational wealth changes, as more and more people get an increasingly global world, more younger people, more people who are building their own businesses are starting to become new owners of wealth. We're going to see that money is going to start to flow into the hands of shareholders and who are aligned with this vision of an ESG focused world. I do think that we're at the beginning of it. I am not saying that we're not there, but I think, like Deborah said, we're not going to get there by pixie dust and wishing. I think we need to really build some good models. And I think economists and consultants and investors, I think everybody in finance, everybody has a role to play in how we reimagine the world. But what we're really doing now is we're saying that we've lived in a world where, for as long as we can remember, companies that got public, like Alessa was saying, had to care about what their shareholder maximizing profits. And they did that for a long, whether it was cutting down trees in the Amazon or burning coal, it didn't matter what you did, so you got to profits. And I think that historically, we're getting to a point, we started to get to the point where we're talking about this a lot more, and a lot of this hype, I think we've already talked about this, but I think at the core of it is really the beginnings of a change and a transition. I'm quite confident that as more and more people start to have these conversations, they start to think about how can we marry those two seemingly opposing camps, we find that in that middle there is both really interesting returns, but also really positive impact for the environment.
And by the way, to add to the overall discussion, because there's not necessarily like two different sides of the equation, because investors themselves are asking for a different system, because we have members who come from the world's largest asset managers, and they are asking for much more stringent requirements, for more kind of like regulation, more best practices, like all of that, right? So this is happening, and they're actually leading the way. A lot of them are leading the way. They are asking themselves for a different system because they say themselves that the current system doesn't cover it enough. So they have to be activists and lead the way, but they would like to have a system that actually includes this much more than it currently does.
Super. If you want to add something.
Sure. So, and I've been told also, I probably after this comment would need to step, but I would say in response to shareholders versus stakeholders, the way I like to see it, and it's not unique. I like to see companies as projects or products, right? And it's CEO as the product owner or project manager. And when you think of your stakeholder, you need that stakeholder map where you think of a 2x2 matrix, what the influence of power is and what the level of interest in the project is. And then you put everyone within that matrix and manage them accordingly, including your shareholders. I don't see them as any more or less significant than other people within that stakeholder matrix. So, and it depends on the specific type of shareholder. Obviously, they could lie in a different part of that matrix. So I think when managing stakeholders, it's a multiplayer, multi-level type game. You need to think about that longer term strategy. It's not just a kind of once and done type engagement. If you're looking at building a sustainable product or company. Yeah, so that's my simple or simplified view around stakeholders versus shareholders. As I think shareholders are just one of the pieces in that stakeholder map, and they should be managed accordingly.
Thank you, Zubair. However, no profit example foundation have fallen into the same kind of investing like profit companies because they need to survive. And Vanessa asked, was an IRR acceptable for an impact investments because there has been deprioritized? Jazeel.
Absolutely. To Vanessa's question on what IRR is required for an investor, I think it depends on the investor. I can give you a number. I think that most people would probably love like 30% IRR if you're like in DC. There's all these like numbers I can throw at you, but I think it's a case by case basis. I think some investors are impact first, and so they might look at a 10-50% IRR. So people might want like a 40% because they're more profits first. So it depends, is what I'd say. But I'm happy to if anybody has an opposing thoughts.
Thank you, Jazeel. Hans, if you want to take this one, do you think a financial service like bank, which is built on profit, can be pushed to social causes like homeless, elderly, healthcare?
I was reading that question earlier, actually, half an hour ago, and that's the reason why I gave this example, because that's, I'm actually working on something like that. It's if a real estate company who manages a lot of housings and lots of flats, they won't accept any homeless in there and give them a chance to get an address and to apply for jobs. Because the homeless or the people who are there, they're sort of poor, they're unstable, they don't pay their rent, and of course they break a lot of things. So at the end of the day, these companies will not do it because they know exactly that by year end they will have a loss in the balance sheet. So the question is now, how can we transpose and transfer that loss they will have in the balance sheet into something, meaningful? And my ideas, and we're working on that one, is basically to tell them that they should take that loss, but at the same time they should communicate that they do something good for society, and with another non-profit organization, and so they turn that loss which they will have into a positive image, which is an investment actually in communication. Rather than paying some agencies for setting up a new logo or finding out whether they will just say, yeah, we had a loss, but we took it, and because we have helped 35 or 350 homeless in a certain city to get back into the jobs, which I think it's a very good idea, and that will have an impact on people. It has an impact on lives. It has an impact on society, and it is possible actually.
Thank you, Hans. We have two more. We can go very fast. Alessia, how do you prepare a financial projection for a startup that has no sales or customer base yet? This is more general.
So it's important to look at do benchmarking, basically, like competitive analysis, like looking at numbers, like for the market itself, existing business models, like how do they seem to quantify and run their P&L, what are the drivers of that P&L, what are sort of like the main leverage points that can grow the model, that can grow the revenues. So just getting to that understanding for an area that maybe it's like highly innovative, and so there's obviously nothing that is one-on-one comparable, but when it comes down to the business model and how the P&L grows, then there's always parallels. And so it's really kind of like on one side, understanding well the market, the sizing, the growth rate, the specific verticals as well. For instance, like landing and expanding in SaaS versus having like a very kind of generalized approach to the model. So being specific and then expanding into like adjacent markets, like versus actually like approaching several markets at once, several sectors at once. And then just understanding what the main drivers are, comparing it with benchmark analysis, like in the market of like, what are the valuations as well? And how do investors look at it? It's like, what are the multiples that are applied if you need to come up with a valuation as well? So kind of on one side, looking at the macro and analyzing like the market and where that's going. And then on the other side, like how specifically companies in similar areas are being valued.
Thank you, Alessia. I will take the last one, and after we need to close. Zube, if you are still online.
Final question.
But you are an angel, so you can take it, and after we need to close. Pre-seed startup is being given a low priority. The vanity of metrics to most of the pre-seed startup is hiding them from being funded. How do investors address this?
So it's in my view, not a vanity metric. There are quite a few studies that have shown the disproportionate allocation of capital, right? So in itself, it's a challenge to all capital providers. And sometimes it's conscious, sometimes it's unconscious. So where one is in a position and able to address that situation, I think it's a privilege. And then it goes into, I mean, it's not like one is reducing the barrier to greatness. It's just being more inclusive with respect to the lens that you use to assess greatness, and looking at it in more ways than you might have traditionally experienced, because you haven't ventured out of your comfort zone, or you haven't seen as many case studies to give that particular education on what good looks like. So those are my views on investing in diverse founders. For some people that do say they are investing, and you look at their statistics and it's woeful, I urge them to do more. If they are challenged with finding talent, I can
send a whole raft of talent their way. Google did a really, and the final point I'll make on this, Google in London did a really good program last year where they focused on Black founders. And for that program, I mean, Rachel talks about this extensively. For that program, they had a phenomenal range of excellent companies that applied. In the end, they were able to accelerate maybe just over a dozen within the Google Black Founders Program, and they funded equity-free capital allocations into these companies. And they were able to, those companies that went through the program, after the program, were able to raise over £70 million from private venture and angel capital after the program, because people now saw Google as a benchmark for good and looked at that portfolio and now looked into the metrics and said, wow, okay, these are fantastic companies. So it's just expanding, going out of our comfort zone and doing a little bit more work. If you need help, you could reach out to me after this and I'm happy to point in the direction of other talented founders. Thank you.
I really thank you, all of you, for coming. It's been a very great pleasure for me. Zube, Jasil, Hans, Alessa, Deborah, thank you very much and hope to see you again next time.